Macro investing is a journey. Join me, Raoul, as I go on a journey of discovery through the macro landscape. This is how I build my macro framework, by talking to the smartest people in the world. Keith, fantastic as ever to get you back on Real Vision.
Thanks for having me. Always a good chat I'm sure we're going to have.
Yeah, absolutely. So, listen, as ever, let's start with a little bit of your process for people who aren't familiar with the process, and then we'll kick into where you think we are, and we can start digging into stuff from there.
Cool. We use a four quadrant, or we call them the quads framework, and we try to front run the rate of changes, in the rates of change in growth and inflation. So we call it quad 1, quad 2, quad 3, and quad 4, of course. And different countries do different things all the while. So this year, the big slowdown call was in China first. So that was the first economy to hit a nasty, what we call quad 3 stagflation. So that's an example of that, where you have real growth slowing as inflation accelerates. And then you have the USA, which has been oscillating back and forth, peaking quad 2 when you have both growth and inflation accelerating at the same time in Q2 of this year, having a stagflation in Q3. Which is when, again, real growth went from 12% to half that growth rate, and inflation continued to go higher. So that's, again, rising inflation with falling real growth, to this outlook that we currently have, which is we think that we're going to make another pivot, or the economy in the U.S. is going to reaccelerate, albeit briefly, 3 to 6 months. We'll have to see on that, back to quad 2. So I think that that's really, just using the lens of the framework, just to give you some specific examples in terms of where we stand. And it's been quite exciting, because anytime we make what we call a quad shift, or, because again, all of our asset allocations right down to the screws, are back tested against the quads. So, any call that I make is, rules based in that nature. Of course, it has to signal. So again, just to put the final point on the process, the signal is constantly front running the quads. So in other words, the market signal, my market signal, is a price, volume, and volatility signal, which really focuses on the vol of vol, or the volatility of volatility. Obviously, if volatility starts to break out on a trending basis, that asset class is for sale, in some cases in a very meaningful way, and the market's very good at front-running the economic scenario that you're about to see. So again, use the signal to front-run the quads, and ride those quads when you're in one, because it can be quite fruitful. One very good example of that, since June of last year, was to be long of inflation, just outright long of inflation, instead of whining and complaining about it being transitory or some other word. I just call it trending. So we've been basically short dollars and long commodities for that whole period, and it's been quite a ride. I haven't had to second guess that one too many times, because there haven't been many signals to do so.
So it's always interesting to talk to you when we're seeing a potential transition that you're picking up now. So how are you currently positioned in the portfolios? And then how do you think it's going to change? So let's talk about the current positioning, and then to how we think it's going to develop from here.
Yeah, my biggest short positions are still China across the board. Hang Seng's the biggest, EWH on the ETF side. We've added short side South Korea. They're tightening into what we call a quad 4 slowdown, or into a disinflation. And Australia, we've also added to the short side South Africa as well. So we have shorts, obviously, and then we have longs. Our longs have been generally European and the U.S. For that matter. We've recently started to add a couple emerging market countries. We've been long, oily, if you will, emerging markets like Russia and Saudi Arabia the whole while, long of India as well. They're in quad 1. So again, we take the economic quad that you're in, where the signal's confirming that. If you're asking the question just on the U.S., I think that's the real pivot that could be happening. I think that's what you're asking about.
Yeah, right? Yeah. Well, overall, but I mean, it's good to get the broader context. But let's talk about U.S. currently.
Yeah, because I mean, the broader picture for me, and that's another big differentiation with us, is that you don't have to be right on one thing. I can be wrong on some things, really wrong on some things, but provided that I'm generally right on 2/3 of the things, then I have a central tendency to make money. So that's how I do it. I mean, I'm generally, I cap my asset allocations at both the asset at the whatever we're talking about, whether it be fixed income, currencies, commodities, et cetera. I also cap my max position sizes. So there's always somewhere to be within the process. But in the U.S. model, where I get the most questions, because I think, I don't think, we know, consensus went bearish on growth because growth slowed in the U.S. into the thralls of August, where we saw COVID peaking, or the variant peak, and the variant narratives associated with that variant peaking. Because now we see a whole bunch of people bringing a whole bunch of bearishness back into the fore, and you see that our nowcast for GDP for the fourth quarter continues to A, rise, and B, is almost, well, it's not a double over the Atlanta Fed, but it's a significant delta over, and I call the Atlanta Fed nowcast consensus. So sometimes we're on the screws in line with them, sometimes we vary, and when we vary, I can generally see that in market positioning, and that's another big component of what I do. If I see something developing in our model, again, the probability of a reacceleration in the economy as variant COVID cases decelerate, which we've just seen big time in this most recent week, and the commensurate breakout in bond yields, that to me is a big opportunity, because Wall Street's basically, betting against commodities, and have the whole way up, by the way, and long duration. People are long deflation duration again, which is kind of crazy to me. Certainly given, what we're seeing in the energy markets today, or in the last week for that matter. So, I do think that we're going to, as we go throughout the quarter, the reopening gives you a reacceleration. Doesn't have to be monstrous, but it has to be, delta, pardon the pun, the delta on the rate of change has to be positive for me to be right on that. If I'm right on that, I think bond yields could go to at least 175 on the 10-year. I think a lot of people, like I said, are caught short. They're basically, they're sitting there saying, well, in the short term, I'm going to stay with bond yields breaking down when they're breaking out. And that's, to me, that's probably the most obvious thing that's trickled into the equity market, is that now the bear case is crazy, right? Like last week, I sit there and I listen to the end of the world. That's China contagion's the bear case. Everything's going to slow. And now it's like, oh, everything's going to accelerate and bond yields are going up too fast. It's very hard to follow the macro tourism of it all. So I find myself much more comfortable being uncomfortable, as I always am with my own process.
So when you're looking at the growth reacceleration in the US, how do you see it across sectors? Things like housing and some of them where maybe there's a different slowdown. Are you seeing a kind of divergence amongst different sectors, or is it you're seeing it broad-based?
Well, it would just be reversing the two big ones are inventory and the services sector. So the services sector, if you just take it and quite literally put a rate of change map on top of, the variant and its acceleration into August, what you see is that the services economy, fully loaded with employment, slowed. And it didn't slow like immaterially. It was a horrendous jobs report. We saw a series of diffusion indexes slow on a sequential basis. They were already going to slow anyway, Raoul, because we had the peak of all peaks in rate of change growth and inflation in the second quarter. They just started to slow at a faster rate in August, and anybody who uses a stochastic methodology like I do could have seen that. So what I'm saying is that, again, COVID cases roll over and the services economy takes off. The bottlenecks start to come unglued, albeit at whatever pace they do. There's a whole bunch of bottlenecks, which we can discuss. But again, those inventories start to be released alongside consumption growth. And those are the two big ones that would take my GDP model to 6%, call it year over year. We're tracking at like 5.82 if you really need to know the number. But to get to 6.21 or 6.5% GDP growth, and again, I think the Atlanta Fed's at like 3.5. All I have to do is be right on inventory and consumption growth reaccelerating.
Yeah, I spoke to David Rosenberg this week, and he says the Fed's forecast is 7% for Q4. So, and while the Atlanta Fed's much lower from their observation, but you sound like you're more in line with what the Fed is seeing, which is a strong Q4.
Yeah, I mean, as you know, I couldn't give a rat's ass what the Fed thinks. I mean, their models. I mean, it would actually it's kind of frightening that we have at least close to the same number. All I care about is the rate of change accelerating from where it was specifically in August, but really into the end of the third quarter into the meat of the fourth quarter, and the fourth quarter in its entirety. The way that the model works is pretty simple. If GDP growth went from 12.18% in the second quarter to 5.9%, and then it goes back to 6 anything or goes to 5.9 something, that would be defined definitively mathematically a quad 2 acceleration. Now, some people they poo-poo that. I mean, you can go back and take Rosenberg's entire career. That's a long time series. I've got a lot of respect for the guy. But it's very hard to find an acceleration towards 6-something% U.S. GDP growth. Yeah. I mean, it's blinding to try to find 3.5% GDP growth. So again, I think that that's a material, level, particularly if you're accelerating into it. And again, I didn't come into this blind to the fact that we were going to slow. I mean, I was long gold, and then now most recently I should have added to that view. When we go from quad 3 to quad 2, when you go from stagflation to rip roaring fun, quad 2 inflation, nominal growth, you got to short gold. So I basically take my gold longs, sell them, short them. Take my utilities longs, which are longs in quad 3, sell them, short them. Do the same thing with consumer staples. So those are some of the other pivots I didn't add to just in finishing one of the initial questions that you asked for. And I do think that that's playing out in the market right now. I mean, again, back to my friend Rosenberg, two Canadian guys, we get along. We've had different discussions on Hedgeye TV. He was citing what the bond market was saying when bond yields are going down. Well, what is he saying now when they're going up? I mean, I think the bond market's figuring it out.
And what does it mean for tech? So in this Q2, does tech underperform?
No. I mean, if you have 25 basis points of 10-year yield rising in 3 trading days, it's not just tech that's going to go down. I mean, a lot of things are going to go down exactly. because that really moves the move index. It moves the entire edifice of volatility across asset class, right? As you know, you move the move index or treasury bond volatility, you start to move, equity volatility. What's been interesting, though, and again, it's a bond market signal, is that you've not really moved high yield in terms of its volatility. High yield OAS spreads have been dead quiet, doing nothing in, today, which is a pretty volatile day in U.S. equities, or the bigger one, which is, of course, the big China Monday. High yield didn't care, so you don't really see the cross asset class links that I look for when I look for getting, when I make a quad 4 call, I'm very explicit on that. Quad 4, for those of you that don't know me, we invented it. It's when the shit hits the fan, you get the fuck out of everything and you buy, you get long dollars and you buy treasuries. I mean, that is absolutely not what's going on right now. When the bond market starts doing this, it's telling you that it's getting hawked up about nominal growth. And that's really what I think the signal is there.
And so you think, so where are the positions wrong currently? Where's the market position wrong? It's obviously going through the adjustment, as you've talked about, but where's the real risk in this to people who've got the wrong bet? You talked about gold. I mean, gold's traded like shit for a long time now. That's the official technical term, obviously. Yeah. But what else is there?
Yeah, gold's traded 10 pounds of shit in a 1 pound bag. I mean, that thing's been, but that, if you backtest every single thing that ticks in macro against the quads, you shouldn't have been surprised by that, nor were you, which is, again, when quad 2 busted a move and bond yields did too, and really coming out of October of last year, that was it for gold. Gold had an 18% drawdown. From quad 2 inception till when finally Wall Street realized, wow, we got ourselves some inflation here and nominal growth to boot. The best nominal growth number, best real GDP growth number in our lifetime, and probably the best number we're ever going to see in the second quarter. Where people are offside, I mean, I continue to be almost shocked. I'm very active in commodities at how people aren't just kind of bearish on natural gas. They're like fucking crazy batshit bearish, like net short natural gas. And we're long natural gas. Natural gas is one of the biggest net short positions if you look at futures and options contracts. So again, when people ask me, where are people wrong or where are they on the wrong side of it, I always define that answer through the lens of the futures and options market. I don't say, I went to a dinner with a bunch of hedge funds. By the way, those don't happen anymore, or they didn't for 2 years, so that was kind of useless. But the net positioning of the market is, like I said, they're net long treasuries across the curve, and they're short, or in the case of natural gas, or at a very low level of net length, because it's always a natural net long position in crude oil. And that move today in energy, I think, is just again, once you break out to new cycle highs, and those new cycle highs are beyond 3-year highs, the prior highs we saw at the peak of the last cycle, which was in 2018 in oil. I mean, there are a lot of reasons, Raoul, that we can go through that, I don't want to be Captain anti-ESG, but there are a tremendous amount of CapEx holes in the universe that we have basically centrally commanded and mandated as governments. Not we, I'm not the government, but the fact of the matter is that, there's supply shocks, but there's also a lack of capex that's occurred over a long period of time that's perpetuating these massive moves in commodities, not the least of which are showing you the highest electric bills that Europe's ever seen. And again, that could easily come home to roost here in the wintertime on natty gas on the U.S. side.
I wonder how that's going to affect consumption into next year. You know, as you said, for your models, it's kind of baked in the cake for this quarter. But I wonder how putting up nat gas prices across Europe and then oil prices across the US, what that's going to mean. Because I can't imagine the consumer can ask for wage rises broad-based. There's some, but I don't know. How are you thinking of that?
Well, the labor market, if there was a time where U.S. employees are as cocky as they can be on both, you can see this in the quit rates, on the JOLTS reports, jobs reports. You can see it in terms of people demanding wages and getting it. There is a very tight window here, Raoul, where they can basically get paid. But that's also, I think this is more your point, it's the latest of late cycle indicators, wages are. Labor in general is, right? So by the time the labor market looks as good as the Fed wants it to look, that's the end of the cycle, right? So there's that. Let's just kind of park that there. On the consumption part, I think, yes, I've thought this for a year and a half, and I'm going to think it until I don't think it, which is inflation is going to rip Americans a new one. And B, I'm going to be long it. I'm not going to complain about that. I understand that. I was raised in a family where a firefighter was the income earner, and I know what it's like to have rent or shelter, or in the case of your mortgage payment, as your number one cost of living, and the food and gas you're putting in your car, pretty close second. So I get it, and I think it's going to pound Americans when the economy is actually slowing and they're going to lose their job. So the way I think this ends is the opposite of how I'm set up today. Yeah. And to some people, that drives them crazy. They're like, oh, I'm longer term. I'm like, what are you talking down to me? Because in the short term, I'm making money on that? It's like ridiculous, right? I mean, timing is the name of the game. And I do think we're going to this Wile E. Coyote moment. Let's just put it on the table anyway, in terms of equities, NASDAQ, S&P, made 55 all-time closing highs this year? I think that suffices. Where both commodities, equities, make new highs higher than the consumer can outrun it. And at the end of that, the government tells you, oh, it wasn't transitory. And then when they acknowledge that, it will be transitory. And then you're going to get a deflation. I have that mapping more into the second quarter of next year. Yeah. So, and I understand full well that I'm going to be going from one, which is not unnatural for me. I like to go both ways. But it's quite literally taking everything I'm long now and shorting it. And that's, I'll articulate that to our subscribers as that goes.
Yeah, I mean, it's not now, and that's still only a hunch because we have to wait to see that play out. But what you're seeing is the current strength. So let's move around the world a little bit. So China, where is it, you think, in the cycle? Are we getting to the bottom yet? Are you yet starting to see potential opportunities in that, or is it still cycle down? Forget about it.
Well, no, that's probably the most interesting question, at least that's on my screens every day, is where is, when I look at going back to the methodology, where is stagflation going to look the worst in China? In other words, what is the lowest GDP growth rate and the highest inflation growth rate? That's when you're fucked as an economy, particularly if you're a communist economy that's trying to command and control people. That's not happening. Yep. So that lands squarely in the fourth quarter. So basically the market's already either discounted it and or is going to go through this final processing of it. And the government's reaction to it, which again, governments regulate when shit's slowing. Communists regulate much more aggressively when shit is really slowing. So that to me has been China this year, and it's been a fantastic short across the board. The local indexes, because the Chinese mark them up into the close, the government does, less so than shorting the ETFs. The ETFs have been awesome. FXI, EWH, CHIQ, which is the China consumer ETF, because the consumer's just getting swallowed in this. And but again, I think that the ending of that is like on T-minus, call it 3 to 6 months. And again, like you said, and I appreciate that. On the other, like me, when I start thinking about trading a career away from now for me, which is like 3 or 6 months away, I do reserve the right to change my mind every day. But I also think that the last thing on China, or not the last thing, but one of many things, is that these guys, not unlike the Fed, these guys are putting in $100 billion a day at this point of liquidity. So, as a short seller of China, I don't want to be like the pig at the trough, like taking that, just reaching for that last couple % of the decline. The Hang Seng's already gone down 22% since February, and that's been great. But, and by the way, I don't think that they're going to centrally plan the stock market in Hong Kong up like they do in Shenzhen or Shanghai. But that's the timing. I think we're getting closer to the end of it, but, we'll have to see.
Now, the trade that's been actually pretty hard has been currencies. What do they kind of neither break up nor break down, or the dollar hasn't. How are you seeing that play out now you're moving into this new quad?
Yeah, nothingness is somethingness, isn't it? I mean, and it drives people nuts, right? Like how many times, and I've shorted it every single time. My catalyst to short the dollar is when it gets above the 50-day moving monkey. 100% of the time I've done it since June of 2020. People are like, this is it. This is the breakup. And it's like, nope, sell it. And every time it's worked. Now, at some point, that's not going to work. The way that the back test would teach you if you're using the Hedgeye process is that the only economic quadrant that the dollar is going to break out in is when you have quad 4 deflation. That's because the world is awash with debt. It's denominated in dollars. You don't need a tutorial on that. All commodities settled generally in dollars. These are the days of our lives that you're looking for that deflation trade. I think it's nothingness until my signal says otherwise. What I think is interesting underneath the hood in the currency market, a couple things. One, the relative strength of currencies where the central bank has the balls to raise interest rates, like Norway. Not that everybody trades Noki, but, like I do. But long Norwegian, Norwegian currency against dollars has been great because the Norwegians raise interest rates, right? So it's like, you make some money on that. This is but these are one-offs because central banks haven't had the spine to do that. The other big thing is that the safety currencies. Now, somebody who's looking at a simple moving average of a price, which I'd highly encourage people not to do, uses the volatility and the volumetric studies embedded in the price as well, which I could spend a lot of time on. But what's interesting is that the two big safety currencies, if you will, the Japanese yen, the pairs, the yen against the dollar and the Swiss franc against the dollar, have just gone bearish against the dollar. And to me, you could read that in a lot of different ways, but the big way would be quad 2 globally. That would be like a very, bullish, buoyant, maybe not as bullish and buoyant as the first quarter of this year was, but, a big time, like put it on type signal as opposed to a breakout on the dollar signal.
So, I've always thought about this thinking, okay, so if the dollar is stable, let's say it's not going anywhere, then that's good enough, particularly in this growth scenario you're laying out, that emerging markets can finally get some traction because they've been just not a trade for a while. So how are you thinking about emerging markets overall?
Yeah, you leading me right to where I went on we do a quarterly macro themes presentation. I did that Thursday. So I just decided to broaden out EM beyond we had, like I said, India, Russia, and the two oil countries, Saudi Arabia, KSA is the ETF on that. It's like, sometimes watching paint dry. But if you look at, I started buying Thailand, I started buying Israel, I started buying Indonesia, and it's because there are a couple components to EM that are interesting. One, in terms of inoculation, they're last, therefore the bull case can be further up. So when by the time we hit, and I think that's why India looks so good. I mean, they basically locked down the whole place with no stimulus. I mean, what easier base effect or comp do you want than that? So India, we're going to stay with that on the long side. And it's a particularly good one against China on the short side, I think.
India's just impossible to bloody buy. It never corrects, just keeps going up. And that's all that happens, right? I mean, I love the Indian case, but it's just impossible to even get into the damn thing.
Yeah. And it's what European equities look like, which I'm sure we're going to talk about as well, up until like the last 3 or 4 weeks when rates started to break out. Again, quad 2 interest rate breakout in Europe, and we think it's quad 2 for the fourth quarter in Europe as well. But back to EM, like if you look at our 4 quadrants, there are a bunch of 1s and 2s. Quad 1 and 2 are the best place. It's the only time to be long EM is when you're in quad. The best quad for EM, an EM country, is quad 1, followed by quad 2. The worst EM quad is quad 3, so that's where you have stagflation. You have the worst, and many EM countries, they have centrally basically imposed that on their people without acknowledging it, right? You burn your currency, you give them a higher cost of living, you end up with stagflation, which is a disaster. That's why China is a disaster in quad 3. But, selectively, if you were to look at our models, you're seeing a bunch of 1s and 2s pop up because EM stayed in quad 3 and 4 for the longest. And to me, those are called easy base effects for longer. So when you look out to 2022, that would be a place. I don't know what your opinion would be on that, but I don't know if it's been a everyone offsides trade, but I rarely hear people talk, like perma EM bulls talk about how good they are this year because they got crushed, right? I mean,
I don't think that many people have been in it because it's kind of been just a nothing trade, right? It's not traded well. I think it's off people's radar screens. I mean, the US has been a decent market to own, so people just haven't needed to go looking for risk elsewhere.
Right. Yeah, it's one that, but when it comes back with a vengeance. And again, I do think we need to have a broader dollar depreciation for that to really rock and roll. I mean, think of like this is, again, it's a couple careers away from me, but by the middle of next year, let's say that the U.S. growth is collapsing, which it should against the best growth the U.S. will ever see. And same thing with inflation. What's the Fed going to do, and what happens if Powell's not there? And I have some opinions on why he wouldn't be there. If Powell's not there, that will be the moment for the Democrats to lock arms, if it's Lyle Brainerd and Janet Yellen, and go full-blown MMT. And I've always thought that full-blown MMT is the catalyst for the dollar to actually go down for real. Like you said, like what has the dollar really done in the last 1, 3, 6 months? It's been like Brownian motion, nothingness. But that would be somethingness if they were to go there.
So talk to me about that Powell idea then you've got and the Lyle Brainerd idea.
Well, this thing that I was railing on this morning on Hedgeye TV, which is I couldn't help myself. I'm like Kaplan and Rosengren, both resigning last night, and it wasn't so much the resignation; it was the tone. Like Kaplan, like I said, you're a fucking disgrace, man. Like it's like you're former senior executive at Goldman Sachs. You knew exactly what you were doing. Like he said he was resigning due to the distraction that was him getting caught. Like, really? Like, just man up, apologize. Say, I shouldn't have done that. I'm sorry. I feel shame. Whatever you need to do. But I mean, we're in this. So what I think that links Powell to is them. You can't just distance Powell from two of the most senior guys the Fed's had in a long time.
Because the boss is allowing trading to go on in something that is ethically wrong, and therefore the boss needs to pay a price for it.
Exactly. And the boss, by the way, also did it. I mean, he didn't do it in the way that they did it because they're trading, like Kaplan was trading like 7 figures in notional dollar value of whatever he was trading, like in and around Fed meetings. Like, what the hell? I mean, I don't have every detail on that, so people can fact check themselves. But to your point, they know it's ethically wrong, and that's the point, right? Ethics are one thing, the law is another thing. If you want to cross both, you're going to be in trouble anyway. But Powell, he owned a bunch of municipal bonds, right? And the Fed has never bought municipal bonds. And he knew damn well that they had to change what the Fed was doing during the pandemic to get the Fed to buy what he owned. I mean, I don't know how he can shake that. He definitely can't shake these two guys because they were caught red-handed. He, in his most recent testimony, was kind of waving that off like it was a thing. I mean, imagine you and I, Raoul, who get our net wealth, our reputation, our entire thing is based on taking positions. Like, can you imagine if you and I could just, okay, my position, as soon as it goes down, it doesn't have to go down anymore because I said so. Like, what the fuck?
Yeah. I mean, it's great. But it'd be interesting to see. And you think Brainerd would be the person who would take over? That's your hunch, is it?
Oh, yeah. I mean, she's definitely the front runner in terms of, she's worked with Janet Yellen, obviously. And Yellen really is committed, politically, socially to this. I was just listening to her today. Her and Powell were testifying together. It's very much a socialist agenda, an apologetic one that requires, like, you get into the real upside in wages and subsidizing housing, student loans, and everything. I really do think that those two are quite interested in doing that together. And officially, it's unofficial, but it's really official that we've already combined the Fed and the Treasury. But, I think that next year, if there's a big surprise, I'd say to me, it's that inflation, when it's supposed to disinflate against the toughest base effects you've ever seen, it doesn't, because they have a dollar devaluation policy, basically. I don't know how that's gonna play out, but I definitely think that Powell, in terms of people, like I wouldn't have said this a month ago. I would say that I don't know about you, but I was just assuming Powell's going to take
me too.
another kind of like another round at this, but I think he's in a very difficult spot. I mean, especially as he continues to look wrong on inflation. Don't forget that the Republicans are using it not as a political football, but as as a political football, but as a very obvious reality that the people understand. And that's not unlike, what other parties have done historically. So they'll blame the other party for that. So, how do you have the guy sitting in the seat who's partly responsible for that?
And it kind of makes me think, at some point, if yields go back up towards, 275, 175, 2% at 10-year yields, the Fed, particularly if they make that change, would thinking about yield curve control as well.
Yes, that would be. Now, wouldn't that be something? Now, there's kind of different varietals of that. The Japanese style, or the Bernanke style that never came to be yet. I mean, what's happening now, though, and again, I do think with the yield curve, the yield curve's been great. Trading the yield curve, like if you do it by quad. So there's quad two. Quad two is when the yield curve steepens. That's because the long end takes off and the Fed keeps the short end, tight. So that happened. You get a big steepening. Then you had quad three hit. Quad three is when you get economic stagflation and the curve flattens. So that worked out nice. And now, the curve's steepened, not inconsequentially, actually, in the last week and a half. So we're at 121 basis points wide this morning on 10s, 2s. I think that could easily get to use, I think we're using the same number, but if the 10-year gets to 174, 175, the width of the yield curve could be 150 basis points wide. And that's good for financials. It's good for bank stocks. And, I don't know if you really want to control the yield curve. You should let that go. I mean, the banks need some net interest margin. They need to, find a way to make some real money and then lend it out.
Yeah, but if you pin it at 150 basis points, everyone's a winner. You can run the economy hot. Nobody has to pay the price of higher rates. It's magic. The banks make money. And the Fed actually did this back in the 40s, and kind of it feels like if they want to change the agenda by having massive stimulus and the MMT style stuff, they're going to have to do it. It'll be interesting to see how this plays out next year. As you said, it's a whole different game for us.
Yeah, you pin it. Everybody's a winner. That's the thing. Like, there are a lot of signals out there. I mean, I use the same signaling methodology across my trade, trend, and tail duration. So it's multi-duration, multi-factor. Price, volume, and volatility are the factors. There's so many things that are like jumping off the screen at me these days, things that I haven't even really been invested in before, which include crypto, which I'm long, or still long, and uranium, coal, obviously natural gas. Cotton today broke out big time to the upside. I mean, cotton's not exactly something that it has a secular growth story behind it. So there's a lot going on out there.
Yeah. Nat gas was the trade I completely missed. I mean, that's just been a rocket ship. As you said, if the market's still net short, then it's got further to run still. Until you clean those out, then you can get some mean reversion.
Yep. I mean, talk about like hated, right? I mean, and this is back to this whole ESG policy that we've had for so long. I mean, people just hated anything dirty from coal to, well, I guess they call natural gas cleaner. But the fact of the matter is that these are just places that the institutional side of Wall Street just shot for dead. I mean, energy on the equity side, as you know, is less than, at one point, was less than 4% of the index. Most hedge funds have no energy desks, and now they're starting to build them back again because a move like natural gas, I mean, for me, it made my year. I mean, you don't have to have many moves. Like, I mean, that actually looks better than Bitcoin in the last
it's up 100, little while. Up 146% this year.
Yeah, and it's not just that. It's like if you're trading, like. And I know I get in trouble sometimes calling Bitcoin a commodity. I go, so if people are affected or triggered by that, I go, it's an asset because that's a commodity. But I put it in my screen, in my framework the same way. And so there's no difference to me between, and this affects people, but it's fine. It's just what I do. Just empathize with me. It's just me.
It's how you trade. That's fine.
Yeah. I put lumber in the same machine that I do Bitcoin. Like we put up, I use the same price volume volatility signal. I use the options market to signal on both. I've said this for a long time. I couldn't own Bitcoin till options started trading because that's how I do it. But if you like lumber is a great example. Lumber was a great long. Then it broke trend. And then everyone's like, oh my God, look at deflation, lumber. Now lumber's up 30% in a month again. I mean, it's these things in commodities, just like things in crypto, they've been taking turns. And that's quintessentially a bull market in both crypto and commodities, which guess what? The best two quads to be long crypto, well, backtesting Bitcoin to be clear, not all of crypto, but crypto and commodities have the same backtest. They both love quad 2 and quad 3, which are inflation of those assets in dollars.
Yeah. So you've mentioned Europe a few times. Europe, obviously, everybody's massively underinvested. What's your view?
Well, it's just Europe's going to go from basically the peak that they saw, pandemic peak growth, to the slowdown that they saw in the third quarter, to reopening and reaccelerating. Like we have GDP going from 2 to 4 to 7% by the first quarter in Europe, and that'll be it. To be clear, that'll be it for me. But between now and then, I think that the bond market's absolutely figured that out. I mean, the UK, not called the UK Europe, but I mean, the UK 10-year.
Well, it used to be, but it's not now.
But I look at them together. It's kind of the same point. Like they're all on the same screen. I don't take them out for political reasons or narrative-based reasons. But the UK 10-year yield's up 45 basis points in a month.
Yeah.
Like, to put that in context for people that don't know where that trades, it trades at 1.00%. It doubled in a month. So, and German 10-year yield, I mean, all these bond yields only break out in quad 2. So I think I've got it right. I think that this is one of the few dips we've had in European equities to take advantage of. My favorite right now would be the Netherlands. The ETF for that is EWN. There are plenty of places to go. I called out Russia as well. I think Germany is probably the safest one for people that don't own Europe generally. I mean, that's the easiest one, particularly because now that they have the vote done with. You think of it this way, like my model is basically predicting or nowcasting an acceleration, quad 2 acceleration in economic growth in the fourth quarter and in the first in Europe. And that's X, the Germans behaving like Americans on the fiscal side. So anytime that you get more goodies from this new government or whatever this is going to look like, if you get anything that's stimulus, that's going to, because my model only updates, nowcasts only update when you get new reported economic data. So government spending could actually be one of the upside numbers. In addition to inventories are a big component of the German GDP number as well. So again, think about reopening as being delta positive. Again, pardon the pun, in the next 2 quarters, specifically for Europe.
And the basket cases, just as a final sum up, the basket cases for quad 2, obviously bonds. Gold you've mentioned. Any other basket cases people want to short or avoid?
Yeah, anything that looks like duration, longer term assets, yielding assets. Those are the.
So
those
the tech stocks would be in that, right?
Yeah, that one's less. I mean, it's not convincing at all on a back test. There's some sensitivity when rates go up too fast.
Sure.
Like on a
Always.
very short.
Always.
But quad 2. If you just think about what the quads were invented by me basically through the lens of being a modeler of companies.
Yeah.
Okay. So I always try to get people to take these quads and bring them back to where they came from for me. I was a buy side analyst and a buy side portfolio manager. In buy side terms, we would call these pods. Again, we made that up too. Pod 1 is revenue growth. Quads, that's the equivalent of GDP. Pod 2 is cash flow growth or earnings growth, whatever it is that you're modeling. And that pod here would be inflation on the GDP, on the quad side. So again, just take that quad and put it into a company P&L. What's really happening? Well, when you get quad 2, you generally get a acceleration in revenue growth, and you get a commensurate explosion in cash flow growth. And that's when you want to be long a stock. You want to be short a stock when pod 1 decelerates and pod 2 decelerates. So revenues and cash flows decel at the same time. Voila, that's the equivalent of quad 4 for a company. That's a short. So every time, like I've actually had a great opportunity in the last couple of years to reteach or coach people through the quads through a lot of different lenses and make sure that all my analysts are in sync on this. We have 40 different analysts, right? And now they're all in sync on it. We have this awesome backtesting machine, so we can put any ticker in it. And as soon as somebody anyone pitches a stock idea here at Hedgeye, we put it in that machine, and then I'll almost go like earmuffs if it's in the wrong quad.
Yeah, it makes sense, right? Because if not, you're going against the strategic allocation of the model. So,
right.
Keith, as ever, super clear, very actionable. Everybody's got a really good idea of how you think this plays out. What would you need to see to change that transition point? Because sometimes we've seen this before. You and I have talked, and we've gone into a quadrant, come back out of it. What would you need to see for that to happen?
Number one would be a legitimate breakout in the dollar. So that
break higher in the dollar.
Break higher, higher. Another thing would be, like I would have said, if we had this conversation 2 weeks ago or a week and a half ago, I would say bond yields breaking down towards cycle lows, oil failing at its most recent high. In fact, the most amazing thing about like the last 3 to 4, well, really since the China day over a week ago, which sounds like forever ago, you know, those things have done the opposite of what would make me wrong. Like in terms of how
they're
I
all
look at
confirming your view right now.
Right, but the dollar, you know, get the dollar right, you get, you know, Hedgeye's process right is basically the point, and so that would shake me the other way. The other thing is, like, you know, every day. Would
it shake you the other way? So let's say the dollar does break higher. Does that entirely change the quad, or does it just kind of lower the conviction level of the quad because you've got all of these other signals going on, like bond yields and commodities?
Well, it would tone down. It would say, okay, like today is literally the best day. You know, if you do everything like I do, I mean, you're not just like a monkey looking at spies or SPY futures. I mean, today when bond yields are hitting new cycle or hitting 155 on the 10-year, and commodities were hitting new cycle highs, and oil was at testing 77 on WTI, and natural gas was roofing it through 6. I mean, that's like quad 2 central. Now, if the dollar were to break out from here, those might be the highest prices you see for the next 3 years. Like, I don't know. And then what I'd be saying is that the market is really front running quad 4 in Q2 of 2022. That has not happened though, Raoul. Like, my model's basically been in this window of 1 to 3 months front running into the next quad. It's in some cases it's commensurate with the quad trade. For it to look ahead 7-8 months from here, I doubt it. But, like, you know, God willing, I wake up with 2 feet on the floor every day, willing to change my mind. So I have an open mind to that. I know what that looks like.
Yeah, and if the model gives you the signal, then we know. Yeah. Keith, as ever, fantastic, really useful for everybody, and I really appreciate you coming back on, and good to see you.
Yeah, good to see you too, man.
All right, take care. Macro investing is a journey. Join me, Raoul Pal, as I go on a journey of discovery through the macro landscape. This is how I build my macro framework, by talking to the smartest people in the world.
Hey there, since you got to the end, I'm guessing you liked the video. And that's probably because we don't just turn on a camera and film. We work really hard on getting the narrative flow just right. And that's why many finance companies are actually now hiring Real Vision to make videos for them. One of our recent client videos just hit 100,000 organic views on YouTube, and there were no kittens in sight. So if you want to find out how Real Vision can make a video for your company, just email us at customvideo@realvision.com.